So, can $1,000 a month actually build a real fortune? I know, it sounds like a bit of a stretch, but you might be surprised what the math says. Today, we're going to break down exactly how that consistent saving can turn into some seriously life-changing wealth. Okay, let's get right to it. You put in the work, you're disciplined, and you manage to put away $1,000 every single month. What does that actually get you in the long run? Let's forget all the vague talk about saving for the future and look at some hard numbers. What's the potential prize at the end of all that effort?
$2.28 million. Just let that sink in for a second. Now, look, we have to be super clear. This is a hypothetical number. It's based on investing that $1,000 a month for 30 years and hitting a 10% average annual return. That's kind of been the historical average for the stock market, but it is absolutely not a guarantee. Still, it shows you what's possible. Seeing a number that big can feel a little unreal. I mean, how does putting in a total of $360,000 over 30 years magically turn into over $2 million? Well, it's not magic at all. It's math. And it's all powered by one of the most incredible forces in the entire world of finance. It's all about compounding. You've probably heard that term, but the best way to think about it is like a snowball rolling down a really big hill. It starts out small, but as it rolls, it picks up more and more snow, getting bigger and moving faster. With your investments, your returns start earning their own returns. Your money goes to work for you, and then the money it makes also starts working for you. And this right here, this is that engine of wealth in action. Your initial money earns a return. That return gets reinvested, which makes your pot of money a little bit bigger. So the next time you earn a return, it's on that larger amount. It's this beautiful, powerful cycle that just keeps feeding itself and growing stronger. But for that little snowball to turn into an absolute avalanche, it needs a really, really long hill to roll down. And in investing, that hill is time. Time is the secret ingredient. It's the accelerator. It's the jet fuel. Without a long stretch of time, compounding is just a neat little concept. But with it, it's a legit financial superpower. To really see what I mean, let's look at a classic showdown. We've got investor A, who invests for just 10 years, but starts early at age 25. Then there's investor B, who invests for 30 years, 3 times as long, but starts a decade later. So, who do you think has more money at the end? It's investor A. Yep, you heard that right. The one who invested way less money actually ends up with more. That is the jaw-dropping power of time. That extra decade at the beginning gave their money a massive head start on the compounding journey. The big takeaway here is it's not just about how much you invest, it's about how soon you get started. Let's look at how that growth really picks up steam. After 10 years of investing our $1,000 a month, you've got around 207 grand. Not bad, but in the next 10 years, that leaps up to over 766,000. And that final decade, it's just explosive. It rockets you past 2.2 million. The growth isn't a straight line, it's exponential. That's the snowball effect in full force. Okay, so we've hammered it home. Time is your best friend. But once you're in it for the long haul, the type of investment strategy you choose can also totally change the outcome. Not every path up the mountain is the same. One of those paths uses something called gearing or leverage. Basically, it's an investment strategy where you use borrowed money to increase your investment size. Why would you do this? Well, it's for people who are really confident a market's going to go up and they want to maximize their returns. But, and this is a big but, it's a double-edged sword. It magnifies your gains, sure, but it also magnifies your losses.
So let's see what this looks like in the real world. Imagine 2 investors, both putting $1,000 a month into funds that track the NASDAQ 100. The investor on the gray line is using a standard, regular fund. The investor on the orange line, they're using a geared fund. Same money in, same time period, but their paths start to look pretty different pretty fast.
And here are the numbers to prove it. They both put in the exact same amount of their own cash, $60,000. But the standard strategy grew by about 35 grand. The geared one, it grew by over 51,000. That's a nearly $17,000 difference in growth. A bigger reward? Absolutely. But it came from taking on a much bigger risk. So clearly, your strategy matters. A lot. But we've got to be realistic here. These numbers are all based on what happened in the past, over a specific window of time. The real world is rarely this clean and simple. And that brings us to our little reality check. Because look, any investment journey is going to run into some headwinds, and understanding what they are can help you stay the course and set some realistic expectations for the road ahead. First, markets are volatile. You're going to have good years and bad years. Ups and downs are just part of the game. They're normal. Second, you've got fees. Even tiny-looking fees can really eat away at your returns over decades. And finally, there's inflation, always working in the background, making every dollar you have worth a little bit less in the future.
And that's exactly why smart investing isn't always about chasing the absolute biggest returns. Like this quote says, sometimes the goal is just to have a smoother ride. Protecting your money when the market goes down is just as important as growing it when things are good. Because trust me, big losses are really, really hard to bounce back from.
So after all these charts and all these numbers, what's the real takeaway? It's this. Don't get fixated on hitting some exact number like 2.28 million. The numbers are just here to illustrate a point. The real power isn't in the number itself. The power is in the principle behind it all.
And it really all boils down to these two simple but incredibly powerful ingredients. First, be consistent. Just make investing a regular habit, no matter what the headlines are saying. And second, give yourself the gift of time. Start as early as you possibly can, and just let that compounding snowball do its thing. It'll do all the heavy lifting for you.
At the end of the day, the ideas are simple. It's putting them into action that really counts. You could think of your financial future as this book that hasn't been written yet. Every single investment is a word on the page, and every year is a new chapter where the story just gets more and more exciting. The only question left is, when are you going to start writing?